What's up, YouTube? Welcome to 132 Investing. So, the purpose of this channel is to bring you more contents about investing, and I want you to come on this investing journey with me. So today we're going to be going over stocks and bonds. So, what is a stock? A stock is a security that represents ownership of a company. They are also known as equities. And ownership are also measured as shares. So you'll often hear people say, "Oh, how many shares of this stock I have this many shares of, let's say, Tesla stock." So investors own a piece of the company when they purchase the stock of the company, which means that, let's say I purchase, or I'll give you an example right now. So some of the key questions you could keep in mind is, why would a company should want to issue stocks, and how can shareholders make money? So companies want to issue stocks uh, to gain capital for their businesses. And you'll see that in an example in a second. And shareholders make money as the business that they invest in grows. So let's say a coffee shop down the street from you is going out of business, and the owner is in desperate need of money, and he begins looking for investors. So he puts out this form where he asks for $100,000, and in exchange, you as the investor keeps 50% of the business. Let's say hypothetically the business does really well and starts a chain of coffee shops all around the world, and the business is now worth $1 billion. Like I said earlier, as an investor, you gain money from the business or from the stocks by with the business doing really well. So as you own 50% of the company, you will also receive $500 million. So this is an example of where stock does really well. However, on the other hand, let's say this coffee chain doesn't do so well, and once you give them the $100,000, the business just go bankrupt, and they don't make any money anymore, and the business is now worth $0. So as you own 50% of the company, and because you invested in $100,000, you won't be receiving back anything. So this is why people often say that stocks are very risky, but yields very high return. Okay, so next, what is a bond? A bond is a loan type investment. So what this means is basically that investors are basically loaning money to bond issuers. And some of these issuers can include companies, governments, or even municipalities. Municipality is basically like a local government of a city or town. So, what makes a bond special is that issuers promises investors a fixed percent interest rate throughout the duration of the bond, which is also called coupon rates, and bond issuers promises investors to pay back their initial amount of their investment 100% of the time. So the value that is paid back, or is also called the par value, but people also call it the face value. And bonds are paid on the maturity date of the bond, which is just end of the contract. So this may sound a little bit confusing right now, but I'll show you an example. Oh, later. The par value of the bond never changes. Keep in mind, the par value of the bond never changes, because the par value of the bond is your initial investment. And bondholders will always get paid out first at the maturity date, as long as the bond is solvent and the company have the money to pay for it. And keep in mind that bonds are usually uh, $100 to $1,000 depending on the company or the government you're investing in. So, moving on to the example, let's say you buy a bond for $100 at 4% rate for 30 years, 4% coupon rate for 30 years. Normally, this is a really good deal because you get 4% coupon rate. This may not seem like a lot, but it adds up. And suddenly, the market's interest rate rises to 10%. So now all the bonds in the market is 10%. Coupon rate of all the bonds in the market are offered 10%. And you want to sell your bond and get a new one that yields 10% interest. So what should you do? So so you should keep in mind that by lowering the price, you can always sell off your bond by lowering the price, or you or bonds are very liquid and you can always trade it with someone else. So let's say you wanted to sell it and get a new one, you would just simply lower the price of your bond and offer to other investors. So Right now, because our bond interest rate is lower than the market interest rate, so I will be lowering the price of my bond so that other people will be interested in it and buying it, so I can sell my bond and get a new one at 10%. So the new price on the bond would be $50 at 4% coupon rate for 30 years. Okay, now let's say market interest rate suddenly drops to 2%, and you have a bond that's at 4%. Other investors are very jealous and wants that 4%. So what you can do is to raise the bond's price to about maybe like 150 or however much you want, so that other people will think, oh, they're buying it and they get a really good deal because the market interest rate is at 2%, and you will be also making money from the bond because you're selling it for 150 every bond. So market interest rate is inversely related with the price of the bond. What this means is that if market interest rate increases, then you will have to decrease the price of the bond to sell it. But on the other hand, if market interest rate decreases, then you can increase the price of the bond to sell for more profit. And factors that can influence the bond price is credit rating, inflation rate, interest rate. What I mean by credit rating is the credit rating of the business or government that you're buying the bond from. Oh, well, you'll see in a second. Or so, which one should you choose between a bond and stock? There's no right answer, but to investors, stocks tend to be more risky but also yield a higher return. Bonds are less risky but also yields less return. So, depending on your financial situation and how much you can handle risks, you should choose accordingly to you. And where are some of the places you can start investing? So, some of the places that you can start investing that I would recommend is, for example, Yahoo Finance, Vanguard, E Trade, Robinhood, Charles Schwab, etc. So some of the really easy choices are obviously Yahoo Finance and Robinhood. Those are probably the really mainstream ones right now, and they're always the easiest to use for beginners. Now it's time to build. Once you figure out where to start, it's time to start building your portfolio. So a portfolio is a collection of investments, and what I mean by investments is, for example, stocks, bonds, cash, and other types of assets. And there's three types of portfolios. There's income portfolios, balanced portfolio, and growth portfolio. So what is an income portfolio? The goal of an income portfolio is to preserve your income. So it is much less risky and less volatile compared to the other two portfolios. So some of this example of an income portfolio includes like putting 100% of your portfolio, 100% of your portfolio being all bonds, 100 to 70% bonds in your portfolio, and having, let's say, 0 to 30% stocks. So if you look, I said that 100% bond for your portfolio from 1926 to 2020 will yield a 6.1% average annual return. And 80% bonds and 20% stocks from 1926 to 2020 will yield you 7.2% average annual return. And a 70% bond and 30% stock portfolio will, from 1926 to 2020, will yield you a 7.7% average annual return. So these numbers aren't quite high, but you also need to keep in mind that these are basically almost guaranteed, or not guaranteed, but it's way less risky than having all your portfolios be in stocks. Next is a balanced portfolio. The goal of a balanced portfolio is not to be risky, but also it's not to be too risky, but it's also giving you room to grow your portfolio at the same time. So some of the examples of these would be putting 40% of your stocks, 40% to 60% of your portfolio being all stocks, and having 40 to 60% being all bonds. So with your portfolio being 40% stocks and 60% bonds, from 1926 to 2020, it would yield you an average annual return of 8.2%. 50% stocks and 50% bonds from 1926 to 2020 will yield you an 8.7% average annual return. And a 60% stock and 40% bonds portfolio from 1926 to 2020 will yield you a 9.1% average annual return. So as you can see, from an income portfolio to a balanced portfolio, the average annual return grows as the amount of stocks in your portfolio grows as well. So just keep that in mind as we move on to the growth portfolio. So the goal of a growth portfolio is to make as much money and income as possible. So this style of investing is focused on prioritizing the growth of your money and the growth of your portfolio. So examples would be putting 70% or having all of your portfolio just being stocks, and having like 30% to like 0% bonds. So if your portfolio consists of 70% stocks and 30% bonds from 1926 to 2020, it will yield you an average annual return of 9.4%. Having 80% stocks and 20% bonds from 1926 to 2020 will yield you an average annual return of 9.8%. And having 100% stock, which is yields you the highest annual return of them all from 1926 to 2020, is 10.3%. So what you can see from all three portfolios and the pattern that you observe is that as the amount of stocks in your portfolio grows, the average annual return also grows, which means that stocks basically yield a higher return than bonds, but it's also way riskier. So for this chart, I basically just I list out all of the different portfolio allocations and show you the bonds and how much they can increase and decrease. So if you look at the chart, from 100% to 100% bonds to 0% stocks, you'll see that it's it's only negative 8.1%, meaning that the annual return, the only possible way, the amount of money that you lose is very little compared to 0% bonds and 100% stocks. So from 100% stocks, you see the possibility of possibly losing 43.1% annual return, but it also gives you the possibility of gaining 54.2% annual return. On the other hand, 100% bonds and 0% stocks only leaves you the possibility of losing 8.1% annual return, but you also only are able to gain 32.6% return. So you can also see that as the amount of stocks in your portfolio grows, there's also a possibility of you losing more money than you actually earn. So which portfolio is the right one for you? So there's obviously no right choice of which portfolio you should choose, but here are just some of my recommendations. If you're young and want to grow your portfolio to bring as much income as possible, then choose one of the growth portfolios. For example, choosing 100% stocks because you're still young and you have a lot of time to grow. And if you choose stocks, you can always compound your income, or you can always compound your money, which leads to more money in the future. But if you're young and conservative, but you still want to grow your portfolio, then obviously choose one of the balanced portfolios because they're not as risky as one of the growth portfolios, but they also yield you a higher income than a income portfolio. But if you're older and reaching retirement and don't want to risk losing all of your money, then choose one of the income portfolios. Another example would be, let's say you're very rich and you just want to invest in a stock market, or invest so that you don't lose any of your money and you would just go broke. Then just choose one of the income portfolios because there's no point of you risking all of your money in stocks. You already have so much money anyways. So the only right way is to preserve your income. So a rule of thumb that you should always keep in mind is to subtract your age from 100. But this is an old rule of thumb. So because this rule is too conservative. What I mean by this is, let's say you're 40 years old. According to the rule, you would do 100 minus 40, which is equal to 60% stocks and 40% bond. But if you retire at the traditional age of 65, you still have 25 years left to really invest all of your money. But you're almost at a 50-50 split between stocks and bond in your portfolio. You're wasting 25 years that could be used to bring in a lot of money for you from stocks. So which is why this rule is too conservative, and which is why we came up with a new rule of thumb, which is to subtract your age from 120 instead of 100. Obviously, you don't have to follow this rule of thumb either. You can always just stay in the growth category, but slowly trend downwards with your stock allocation and increase your bond allocation as you reach the retirement age. So one thing I would recommend you to search up or look at is the Vanguard Target Retirement Funds. So these funds automatically rebalance your asset allocation for you every year, helping you lower your stocks and increase your bond allocation over time until you hit your target retirement age. And this can be really helpful if you're someone that doesn't really want to always be looking at their portfolios and just want to take it a little bit easier. Alright, that's it for this video. Thank you guys so much for watching, and make sure to subscribe and like the video, and also turn on the notification bell next to the subscribe button to keep up with my content and keep on learning more about investments as we go. I'll see you guys next time. Take care.